payday loan, also called a payday advance, salary loan, payroll loan, small dollar loan, short-term, or cash advance loan, is a small, short-term unsecured loan, regardless of whether repayment of loans is linked to a borrower's payday. 1, 2, 3. Loans are also sometimes referred to as cash advances, though that term can also refer to cash provided against a prearranged line of credit such as a credit card. Payday advance loans rely on the consumer having previous payroll and employment records. Legislation regarding payday loans varies widely between different countries, and in federal systems, between different states or provinces. To prevent usury, unreasonable and excessive rates of interest, some jurisdictions limit the annual percentage rate, APR, that any lender, including payday lenders, can charge. Some jurisdictions outlaw payday lending entirely, and some have very few restrictions on payday lenders. In the United States, the rates of these loans used to be restricted in most states by the Uniform Small Loan Laws, USLL 4.5, with 36 to 40% APR generally the norm. There are many different ways to calculate the annual percentage rate of a loan. Depending on which method is used, the rate calculated may differ dramatically. For example, for a $15 charge on a $100 14-day payday loan, it could be, from the borrower's perspective, anywhere from 391% to 3,733%. 6. Although some have noted that these loans appear to carry substantial risk to the lender, 7-8, it has been shown that these loans carry no more long-term risk for the lender than other forms of credit. 9-10-11, these studies seem to be confirmed by the United States Securities and Exchange Commission filings of at least one lender, who notes a charge-off rate of 3.2%. 12. The basic loan process involves a lender providing a short-term unsecured loan to be repaid at the borrower's next payday. Typically, some verification of employment or income is involved, via pay stubs and bank statements, although according to one source, some payday lenders do not verify income or run credit checks. 13. Individual companies and franchises have their own underwriting criteria. In the traditional retail model, borrowers visit a payday lending store and secure a small cash loan, with payment due in full at the borrower's next paycheck. The borrower writes the post-dated check to the lender in the full amount of the loan plus fees. On the maturity date, the borrower is expected to return to the store to repay the loan in person. If the borrower does not repay the loan in person, the lender may redeem the check. If the account is short on funds to cover the check, the borrower may now face a bounce check fee from their bank in addition to the costs of the loan, and the loan may incur additional fees or an increased interest rate, or both, as a result of the failure to pay. In the more recent innovation of online payday loans, consumers complete the loan application online, or in some instances via fax, especially where documentation is required. The funds are then transferred by direct deposit to the borrower's account, and the loan repayment and/or the finance charge is electronically withdrawn on the borrower's next payday. According to a study by the Pew Charitable Trusts, most payday loan borrowers, in the United States, are white, female, and are 25 to 44 years old. However, after controlling for other characteristics, there are 5 groups that have higher odds of having used a payday loan: those without a 4-year college degree, home renters, African Americans, those earning below $40,000 annually, and those who are separated or divorced. Most borrowers use payday loans to cover ordinary living expenses over the course of months, not unexpected emergencies over the course of weeks. The average borrower is indebted about 5 months of the year. This reinforces the findings of the U.S. Federal Deposit Insurance Corporation, FDIC, study from 2011 which found Black and Hispanic families, recent immigrants, and single parents were more likely to use payday loans. In addition, their reasons for using these products were not as suggested by the payday industry for one-time expenses, but to meet normal recurring obligations. Payday loans are legal in 27 states, and 9 others allows some form of short-term storefront lending with restrictions. The remaining 14 and the District of Columbia forbid the practice. 64. The annual percentage rate, APR, is also limited in some jurisdictions to prevent usury. 65-66, and in some states, there are laws limiting the number of loans a borrower can take at a single time. Alternatives to payday loans. Edit. Other options are available to most payday loan customers. 78. These include pawnbrokers, credit union loans with lower interest and more stringent terms which take longer to gain approval. 79. Employee access to earned but unpaid wages. 80, 81, 82, 83, 84, 85. Credit payment plans, paycheck cash advances from employers, advance on salary, auto pawn loans, bank overdraft protection, cash advances from credit cards, emergency community assistance plans, small consumer loans, installment loans and direct loans from family or friends. The Pew Charitable Trusts found in 2013 their study on the ways in which users pay off payday loans that borrowers often took a payday loan to avoid one of these alternatives, only to turn to one of them to pay off the payday loan. 86. If the consumer owns their own vehicle, an auto title loan would be an alternative for a payday loan, as auto title loans use the equity of the vehicle as the credit instead of payment history and employment history. Other alternatives include the Pentagon Federal Credit Union Foundation, PenFed Foundation, Asset Recovery Kit, ARK, program. 87. Basic banking services are also often provided through their postal systems. 88. Comparisons payday lenders make. Edit. Payday lenders do not compare their interest rates to those of mainstream lenders. Instead, they compare their fees to the overdraft, late payment, penalty fees and other fees that will be incurred if the customer is unable to secure any credit whatsoever. The lenders may list a different set of alternatives, with costs expressed as APRs for 2-week terms, even though these alternatives do not compound their interest or have longer terms. Citation needed. $100 payday advance with a $15 fee equals 391% APR. $100 bounce check with $54 NSF, merchant fees equals 1,409% APR. $100 credit card balance with a $37 late fee equals 965% APR. $100 utility bill with $46 late, reconnect fees equals 1,203% APR. Variations on payday lending. Edit. A minority of mainstream banks and TXT loan companies lending short-term credit over mobile phone text messaging offer virtual credit advances for customers whose paychecks or other funds are deposited electronically into their accounts. The terms are similar to those of a payday loan. A customer receives a predetermined cash credit available for immediate withdrawal. The amount is deducted, along with the fee, usually about 10% of the amount borrowed, when the next direct deposit is posted to the customer's account. After the program's attracted regulatory attention, 8990, Wells Fargo called its fee voluntary and offered to waive it for any reason. It later scaled back the program in several states. Wells Fargo currently offers its version of a payday loan, called Direct Deposit Advance, which charges 120% APR. Similarly, the BBC reported in 2010 that controversial TXT loan charges 10% for 7 days advance, which is available for approved customers instantly over a text message. 91. Income tax refund anticipation loans are not technically payday loans, because they were repayable upon receipt of the borrower's income tax refund, not at his next payday, but they have similar credit and cost characteristics. A car title loan is secured by the borrower's car, but are available only to borrowers who hold clear title, that is, no other loans, to a vehicle. The maximum amount of the loan is some fraction of the resale value of the car. A similar credit facility seen in the UK is a logbook loan secured against a car's logbook, which the lender retains. 92. These loans may be available on slightly better terms than an unsecured payday loan, since they are less risky to the lender. If the borrower defaults, then the lender can attempt to recover costs by repossessing and reselling the car. Postal banking. Edit. Many countries offer basic banking services through their postal systems. The United States Post Office Department offered such a service in the past. Called the United States Postal Savings System, it was discontinued in 1967. In January 2014, the Office of the Inspector General of the United States Postal Service issued a white paper suggesting that the USPS could offer banking services, to include small dollar loans for under 30%. April 93, support and criticism quickly followed. However, the major criticism isn't that the service would not help the consumer but that the payday lenders themselves would be forced out of business due to competition, and the plan is nothing more than a scam to support postal employees.